to welcome on board Dr. Abhay Soi, the CMD at Max Healthcare as well. Abhay, hi, thank you so much for making time and speaking with ET now. And let me start by congratulating you on being awarded the Entrepreneur of the Year by one of the leading publications. So let me start just with that. What would be that one advice that you would probably give to the entrepreneurs at this point of time?
Well, my only advice is keep working hard, keep at it. Times change. There's always ups and downs, but you have to be at it. And, you have to be relentless.
You have to be relentless, but what seems to be relentless at the moment is the surge in the COVID cases, right? We all thought we were out of the woods, but it seems to be increasing a tad bit. Is that concerning? What are you doing at Max to kind of gear up?
So right now, while we are seeing the number of cases have been increasing, and you've been seeing that in the press, the number of admissions haven't been. So it seems to be restricted to the upper respiratory. There's no cause of concern as far as admissions are concerned. We've hardly seen any admissions. We've only seen situations where in cases of comorbidities, we've seen certain admissions, etc. But that literally you can count over your fingers. We have more than adequate sort of capacity, and we've been through this so many times that the entire systems, the protocols, everything is in place. I think the entire machinery within the hospital system is in place to look at any surges that may be. But at present, I don't think there is any cause of concern really at our end, because like I said, we are not seeing any admissions really, so to speak of.
Good to hear that. Dr. Soi, what I also wanted to understand is whether it's a mild variant this time, and would you say weaker perhaps than Omicron? And if you could really identify, the symptoms, are they the same that were the case in, the previous variants of the virus as well, or much milder this time?
No, so I think it's a milder form of similar symptoms. We are seeing people recovering faster. Besides COVID, what is a cause of concern for us essentially is it seems to be that COVID has precipitated a lot of underlying issues in people. So we are seeing, whether it's diabetes, whether it's blood pressure, and so on and so forth. And these things have long-term implications. So right now, my concern is not so much on account of COVID and symptoms emanating from COVID, because I think they're fairly controllable, and we're not seeing any severe symptoms, so to say.
Okay, that's the word coming in on the spread or the rise in COVID infection cases as well. And as you said, a lot of problems being created on the back of that. But if we were to just get back to your business and talk about your margins, because they've been quite healthy in the range of about 26 to 27.7%. That's for the 9-month period. Given the fact that you're talking about new capacities coming up, what's your outlook on your margins? Do you think that you'll maintain this range?
Absolutely. We are essentially elevating a business need. We have bottlenecks in terms of capacity at present. Our occupancies are close to 77, 78%. These are midnight occupancies. What that means is during the day, we have about 110 to 120% occupancy in most of our hospitals. We need to create more capacity. So what we are doing is we are creating adjacent capacity via brownfields. And when you do that, demand is much quicker on the ramp up, as well as the fact that you have operating leverage because your management cost and your clinician cost, etc., is already being incurred. So theoretically, your operating margins as well as EBITDA per bed should be significantly higher than your current capacity. Because it's a brownfield, these are not greenfields. What we believe is you'll have expansion of margins rather than contraction.
Sure, but could you help us with a timeline with respect to when these capacities are likely to come on board? Because I was reading an analyst note which does suggest that the Shalimar Bagh capacity was expected to come on board already, but there seems to be a bit of delay. And similarly, with respect to Gurgaon, etc. as well, what's the timeline of operationalization?
So Shalimar Bagh capacity has come on stream as scheduled. It's already on stream. We were expecting it in the last quarter of the previous financial year now, and it came on stream as scheduled. We are expecting additional 100 beds that we'll be able to sort of ilk out of the system, and we're expecting 300 more beds in Dwarka to come out by September. So within a space of 6 or 7 months, you're seeing about 500 beds on top of 3,400 beds. That's about 13% more capacity. And we're expecting about 1,000 plus beds next year. So I think in terms of capacity sort of rolling out, there's a large amount of capacity. And like I said, because it's brownfields adjacent to existing hospitals largely, it's quite de-risked.
Would you, for this particular planned capacity, would you have to raise additional funds or are you well funded for the same?
So we are a net debt-free company. We have a net debt positive of about 500 odd crores. We have about 1,500 crores of close to 1,500 crores of cash sitting on our books. And we are generating close to about 250 crores of free cash flows per quarter. And it's expanding. The entire capex is at a cost of about 4,500 crores over the next 4 years. And this should be equal to close to about 50% of our free cash flows. So not only don't we require any debt or any form of external funding, but we have spare internal accruals as well post completion of this capex. So we find ourselves in quite a healthy place as far as this is concerned.
Expansion is going to be largely brownfield, as you talked about, or inorganic opportunities is also something that you're watching out for?
So absolutely, inorganic opportunities is something that we have been watching out for some time. We've been engaging with a few players. And like I said, we have free cash flows to spare and unlevered balance sheet. And we're quite sort of comfortable levering it up to 2.5 times debt to EBITDA. That's a threshold we won't breach. So within that, we have elbow room to do about close to $500 million of acquisitions. So we've been searching out, we've been sort of combing out for and looking out for inorganic acquisitions as well.
Any more color in terms of what could be the timeline, at what stage are the discussions, any particular geography or speciality you're looking at in terms of adding to your capacity through this inorganic route?
Yeah, so we like to stick to what we do, which is multi-speciality quaternary care. As far as geographies are concerned, we've have an identified list of 21 cities that we want to move into in the future. So these will be located in these cities. We have been in conversations for some time with quite a few players. And these things have their own sort of time frame of happening. And, when they happen, they happen. I'm fairly hopeful that over the next couple of quarters, something should work out.
When you say 21 cities or 21 geographies, are they largely tier 2 or 3 cities, or are you specifically looking at metros and larger cities?
So it's metros as well as tier 2 cities, tier 1, tier 2 cities. We already have presence over there. We are in places like Mohali, in Uttarakhand, in Dehradun, in Bhatinda, and experience has been quite good compared to even the metro cities of Delhi and Mumbai. So we're quite confident. These are also places where at least a handful of our competitors have proven viability. What we don't like to do is go into uncharted territories. So these are quite chartered, our peers have proven viability, and we're very comfortable about going there and doing it better, like we usually do in most of the geographies or perhaps each and every micro market that we're present in. We're quite confident about that.
Right, good to hear that. You wouldn't be price agnostic, would you? Or is there something that you've particularly earmarked in terms of a size or scale of this inorganic opportunities that you're talking about?
So larger the better, but we are very conscious that we look for at least 20% ROCE on a cash-on-cash basis, over a space of 4 to 5 years. And so long as we have a clear line of sight towards that, those are the sort of opportunities we are looking at. We are less shaken by headline numbers, but like I said, it's more about 4 or 5 years down the line. That we must be able to underwrite a business case where we are looking at a ROC of about 20 to 25%. So yeah, that's really the threshold that we look at. And like I said, the larger the better the opportunities are.
Seems like you've already closed in on something to acquire.
Sorry, I didn't.
I know. I'm saying it already seems like you've closed in on some property already or some acquisition target already.
Not really. I mean, if that was the case, then you would have sort of read about it in the press, or at least we would have made an announcement via the stock exchange. No such situation right now. Like I said, we at any given point of time over the last few quarters, we've been engaged with at least a couple of parties, and more at times, and we are sort of quite uh, conscious about deploying our capital to work. Our cadence is very, very well defined. So when we are looking at opportunities, we know the sort of geographies we are looking at. We know the kind of ROCs and the operational metrics, etc., that we visualize, that we view. Therefore, I'm able to quite explicitly state those. It doesn't necessarily have to do with any specific opportunities that we're closing out at present.
Got that. But great to speak with you. Thank you so much for taking the time out today.
Thank you so much. Wish you well.